company generally has two records of cash transactions in its checking accounts. Its own, that is the checkbook, and the bank statement. The balances, according to the bank and according to the books, are not usually the same because of what are called timing differences in recording receipts and disbursements. For example, a company will make a deposit, let's say at the end of its business day, say 5, 6 p.m. after hours. Well, they have already recorded that in their as an addition to their cash account for that day, but the bank will not actually receive that deposit and process it until the following day or maybe after that. And so there might be a delay. That's in recording that deposit. That's what represents a deposit in transit. That is a deposit made by the bank at one time that isn't processed or recognized or added to the company's cash account by the bank until a later time. Outstanding checks are something we all understand. You write checks, you mail them, or you give them to a vendor, and then that vendor is going to deposit the check in their own account, and it may take some time, sometimes only a day or two, sometimes longer, depending on whether the check is mailed. And that difference, that time lag between the time a check is written and the time it actually comes back and clears and is deducted from your bank account is called the float. And so companies will have potentially deposits in transit, but will definitely have outstanding checks. And those represent differences between what the company knows, that is what transaction it has engaged in, and what the bank account will reflect. So the bank reconciliation, a fairly common format, is what's called a two-step reconciliation. And the first part is shown on this slide here, where we take the balance per the bank statement on a particular day, and then we adjust that bank statement for deposits in transit and outstanding checks. In other words, information that the company has about deposits it's made and checks it's written as of that statement date, in order to obtain what represents a corrected balance. There's not really an error here, so it's almost a misnomer, but the notion is that this is the balance that the bank would show were it able to process all the deposits and checks that the company has made up to that date. The company knows about deposits in transit and outstanding checks, but the bank has no knowledge of them at that date. And because the company knows about these reconciling items, they have already been recorded in the company's cash account, and so no entry by the company is needed for these reconciling items. The second part of the typical bank reconciliation statement looks like this. We start with the balance according to the company's cash records, and then based on the bank statement itself, we find information, or we get information about transactions that the bank knows about that we may not know about until that point. So the bank knows about interest earned, service charges, customer NSF, that stands for insufficient or not sufficient funds, checks at the balance sheet date. Since these items, though, are news, that is, they're not yet known to the company, an accounting entry is required to adjust the cash account balance to the correct amount. Notice that the bank's record of transactions is not affected by any errors made by the company in recording cash-related transactions. If the bank has made errors, the company will contact the bank, but this doesn't result in any entry on the company's records.